For something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the Hump Day edition of The Real Investment Show. Of course, it is Q&A day, so if you're in our chat right now, go ahead and put your questions in. Danny's monitoring right now. He'll make some notes, and we'll get to your questions right here in just a few minutes. Of course, a few things going on today. Lots of headlines right now because Davos is underway. And every year, of course, we have all the rich, powerful, famous get on private jets to fly out to Davos to talk about climate change. So anyway, that's going on right now, but a lot of people are, a lot of the kind of the major CEOs are now speaking, and Jensen Huang from NVIDIA was speaking a little bit ago. Jamie Dimon, CEO of JP Morgan, just started talking a few minutes. So again, we're going to get a lot of headlines coming out of Davos over the next couple of days as, basically CNBC and others interview them, these kind of heads of tech, so to speak, and heads of finance. They'll be interviewed, and of course, we'll get all their views about what they expect about the economy and those type of things going forward. So we'll see how, kind of what this does to the markets. But again, none of this is going to be really surprising. Most of them are going to be talking about, kind of their outlooks for their specific market sectors, and depending on when they announce earnings, what they can say. Speaking of earnings, of course, we are moving full steam into earnings, of course, over the next really kind of week and a half. Next week will be a really important week. Last night, Netflix reported earnings. Now, overall, the earnings were good. They beat expectations on both revenues and subscribers, as well as the earnings side of their numbers, but their outlook was a bit weak, and their outlook for revenue was a bit weak, and so Netflix is going to trade down about 6.5% this morning on that news. So again, markets are still much more interested in the outlook for earnings and revenue going forward versus what they're reporting for the quarter. And this is going to be one of the big kind of key themes over the course of the next really kind of week and a half, 2 weeks, is going to be what these companies say about 2026. Because I said earlier, going into this year, excuse me, estimates for earnings are very, very robust. And we have a lot of excitement about earnings this year. They're very high levels. One of the largest deviations from the earnings growth trend, historical earnings growth trend in history. And so what these companies say about earnings growth this year is going to be very important to what happens with the markets next. So again, pay real close attention to that, and we'll kind of work through this over the next week or so. But that's going to be one of the biggest either supports or pressures on the markets as we start to move into that. Now, speaking of pressures on the markets, here's what you need to know before the bell this morning. We talked about yesterday morning this consolidative wedge in the markets, and we said that if the market breaks to the downside of that or the upside, then we could get a move in one direction or the other, and it would be fairly large. And unfortunately, because of news over the weekend about President Trump, the debate over Greenland, the markets broke to the downside yesterday. Not only did we take out the bottom side of that kind of rising trend level from the kind of mid-November lows, we've been kind of having this kind of slow push higher. Not only did we take that trend level out, we took out the 20-day moving average. We also took out the 50-day moving average yesterday. So again, we took out several layers of support all in one day. Volume was decent yesterday, so there was a lot of pressure across the entire market. Finance sold off, tech sold off. Basically, everything was selling off yesterday. There were very few places to hide in the markets yesterday from the equity side. Markets, though, did get very, very oversold yesterday. And again, we talked about that yesterday, is that kind of the move, that's going to reverse a lot of that overbought condition that we had. And also, we did trigger a sell signal. So from a momentum basis, nothing good happened yesterday in the markets. But this is not the time to panic. Now, we've talked about this before. There's a lot of people that are looking at chasing stops right here and immediately reacting. It's like, oh, we took out the 50-day moving average. I need to sell my positions. Be a little cautious with that. We've seen these before where we've taken out these moving averages, then immediately rise back above it. Now, this morning, we'll see what happens. Markets are still looking to open a bit lower this morning. So again, we may see a little bit more follow through today. But again, kind of give this a day or so to kind of sort itself out. The 100-day moving average is sitting at 67.20. Doesn't mean, not to take profits or rebalance risk, but we had talked about rebalancing risk and taking profits here about a week and a half ago. So again, it's, when you get in the midst of these sell-offs, we feel like we have to do something right now. But unfortunately, you're already kind of behind the curve of doing something. You want to try to do things before the events occur, not after. So again, be a little bit cautious here. Lots of pressure on the markets. There are buyers sitting here. The money flows yesterday were not absolutely terrible. So again, we're starting to see some improvement on that side of the ledger. Breadth has been weak, but it's not terrible either. So we're kind of watching through this right now. But again, just be a little bit cautious about knee-jerk reacting right here. Again, we may open down a little bit lower this morning, start to rally this afternoon. There are buyers sitting out here, but again, kind of the next level of important support is 67.20 at the 100-day moving average. Now, if we do take out the 100-day moving average, it starts to get pretty dicey from there because we don't have any support till we get back over here closer to 60, 65.50, which are these previous bottoms that we had back in October and November. And below that's the 200-day moving average, which is sitting down at 63.40. So there is, I don't want to dismiss that there is risk to the downside, and you do need to be aware of that. We're also moving into one of the weaker months of the year, which is February. We've had, and we talked about previously, we'd had 8 months in a row of gains. So again, with that much of a run in the market since the last April's lows, again, a month or two of a correction process is not surprising. 3 to 5% happens in 94% of all years. 10% corrections are almost as frequent in markets over years. So again, there is risk to the downside. Don't dismiss that. Be sure and keep a watch on your equity exposures and how you're kind of playing that right now. But again, just don't react until, kind of let the market sort itself out for a day or so, and then start making kind of a measured process of taking action in your portfolio rather than just kind of knee-jerk reacting to it. Just be a little cautious here. Anyway, that's what you need to know before the bell this morning. We'll come back, start with your Q&As right here with Danny Ratliff and myself. Don't go away.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome to the show this morning. We'll get to your Q&A. Danny, how are you?
Doing great.
Good. Did you have a good time this weekend?
I did. It was a great time. Still recovering a bit.
I know, right? Did you have a good time working all weekend? Yeah, it was a ball.
No, I mean, actually, it was actually awesome. I mean, it's so great to meet actually so many of you guys here in the chat. Got a chance to meet a lot of you I haven't met before, and it's just good to catch up and meet people you haven't before. So I always find that kind of exhilarating. I love meeting people from different places and different walks of life, and everybody has a different story, so it's pretty cool.
Yep, absolutely. So, all right, well, let's get into the questions.
Man, we have got a lot of really good questions, but I think one thing that is kind of a recurring theme right now is yields. Yields have popped pretty quickly here, obviously on the threat of additional tariffs with Greenland and Europe, obviously over Greenland, excuse me. So one of the questions was, how high can the 10-year Treasury yields go before actually breaking the market? Is it 6%? What is that magic number? And what is really going to be the thing that keeps these rates higher?
Well, first of all, there's no way to know kind of where that level is. I mean, we've seen rates at 5%. It didn't impact the markets. So is it 6? Is it 10? Is it 12? Who knows? Sure, there's a level in there somewhere where interest rates will impact the markets. But Yesterday was more just of a knee-jerk reaction because of all the news over the weekends. It'll sort itself out. Yields will move back down to 4%-ish over the course of the next month or so. So again, I really wouldn't put a lot of weight on a single-day move. We've seen this type of volatility before. But again, in the longer term, interest rates are driven by economic growth and basically inflation. Inflation is continuing to move lower. Economic growth is doing fine. The Federal Reserve, the New York Fed just came out today. They just increased their quarter one GDP forecast, I think, to about 2.3% for quarter one. So again, 2.3% on economic growth, just call it 2.5, right? And another 2% on inflation. You're probably somewhere around 4.25 on interest rates. So interest rates are trading about where they should be right now. Again, you can get volatility. Just like the market yesterday sold off. You're going to get volatility in these moves, and I wouldn't read a whole lot into it.
I think the biggest concern is just such a sharp increase so quickly.
Yeah. Well, I mean, there was a lot of concerns out over what's Europe going to do. There was a bunch of headlines like, "Oh, Europe's going to sell all their bonds." No, they're not. Denmark said, "Oh, we're going to sell it." So Denmark basically controls Greenland, and so Denmark said yesterday, "Well, if Trump does this, we're going to sell all of our treasuries." Okay, that's about $12 billion worth of treasuries. It's a drop in the water bucket. So, it's an idle threat across the board. And again, but when you have headlines like that, it's not surprising that you're going to get a move in yields.
Yeah, heard an interesting acronym yesterday. I was listening to a podcast that says some of the big banks have started to use the acronym TACO. Trump always chickens out, and so essentially saying that this is a threat, kind of what you're alluding to. And that essentially he'll get people to the table and then, kind of move back from there. But they're interesting either way. Now, on the same kind of vein of yields, what do you think about the Japanese yield curve right now? I mean, that's always been a hot topic since July of last year, year before last. Mm-hmm. Seems like it was yesterday. With the Japanese yen carry trade. Is that something that's still a major concern? Because you do see that pop up in headlines from time to time. And, I think people are still kind of watching, and that seems to be on everybody's radar.
Well, no, they're just talking. It's not the yield curve; it's the yields that everybody's watching. But and what's interesting is everybody's watching the 30-year yield, which nobody uses, right? And it's the longer end of the curve. The one you want to watch is the 10-year Treasury. That's the one that they issue most of their debt in, and that's also the issue that trades the most. That's also the issue that works around the carry trade that you're talking about. Yeah, and yields have risen because the Japanese government's trying to stop QE. They're trying to reverse some of their issues. But you're talking about a 10-year Treasury note at 2% in Japan. So yeah, yields have risen in Japan, but they're not at very high levels, and the economic growth in Japan is slowing very rapidly. Japan's in a tough spot. They're trying to reverse some of this previous action, trying to reverse a lot of this QE. They were the major buyers of their JGBs for a very long time, and they're trying to reverse that, but they don't have a lot of wiggle room. At 260% of debt to GDP, they're going to be back to doing QE fairly soon. It's just a function of time until they get there. There'll be enough pressure economically because as interest rates do come up on that end, it's going to put a lot of pressure on them economically. So at some point, they're going to reverse course and go back to QE, trying to push rates lower. But that's just a function of time. Yeah,
interesting. So kind of jumping a little bit, but staying on the same. So if de-globalization really occurs, what do markets over other countries, can they become more uncorrelated? Looking at the correlation between markets, kind of diversification aspect, does that change the game from globalization where, everybody is kind of intertwined together? And I would think ideally it would to some extent, but how can we really get away from deglobalization?
You don't.
Yeah.
How, I don't understand the question.
Well, so if deglobalization occurs,
there's no such thing as deglobalization. We're all tied together. Everybody trades with everybody. How are you going to deglobalize?
Yeah. Well, I think you should see the rise of nationalism across the world, and if we continue with these tariffs,
that has nothing to do with globalization, though.
Yeah, ultimately, you're saying, hey, everybody wants to reshore jobs.
Okay.
You want to keep money in.
So we're not going to trade with anybody else. We're not going to import anything from China or Europe, and we're not going to export anything to anybody. Is that the idea?
I mean, I think that's what they're alluding to.
Okay, you go with that.
Well, but I think that's a really valid point. Is that how can you deglobalize? And do we really want that? I mean, think about if you went and bought a Samsung TV 15 years ago, what did it cost? Think about it now.
Right.
Or any big screen TV. And so de-globalization in many ways has made it a lot cheaper. Now, we can make the argument from a job perspective here in the States. However, I think it's kind of like everybody wants deflation until it actually occurs. And then you're going to see, we're in deflation. People are going to be fighting for their jobs. We're going to have other issues. Disinflation, which is what we have, is a little bit different. But de-globalization as well, that's going to push prices much, much higher over time. And you're not going to see the wage growth increase enough to keep up with that, unfortunately, I don't think.
Well, no, it's true. So, I mean, in theory, if you basically nationalize the entire country, and so let's say we're not going to import anything, yeah, your next TV you buy is $5,000 versus $900. Because again, we demand higher wages here. But this globalization is what's led to the economic prosperity in the U.S. This is why the U.S. is when we talk about wealth, the U.S. is not just a little bit wealthier than Europe and China and everybody else. We're head and shoulders wealthier than every other country in the world by extremes. And that's been because of this ability for us to, control our outcomes through capitalism, but also this impact of keeping, labor, as an example, keeping labor wages suppressed, increasing profit margins, and passing that through. And so this is what's created a lot of opportunity in the U.S. But again, if you start to reverse that process, and again, it sounds like a great idea, but there's a consequence to the actions, right? So you're going to have a lot higher cost.
Yeah. Okay, so here is a question that I seem like it's been really prevalent in so far in 2026. In fact, I've gotten a lot of this similar type of question where people are beginning to say, hey, I need to shift portfolios, go more towards a large cap value or dividend play, in light of kind of the tech run, maybe getting closer to retirement, relying on dividend income. But so it says, I'm 71, dividend investor. I have a close friend who keeps telling me that I should focus on total returns. What are your advice and thoughts on that?
Yeah, that's all you should focus on.
Yeah.
When you're investing, there are three legs to your portfolio, and you should concentrate on all three legs. And again, most investors don't. They just choose one leg and then they pile into that trade. And so as long as that trade works out, they're good. But when things eventually and inevitably will go wrong, they have no defense relative to that. So a total return portfolio is where you focus on the income, the dividends, and the capital appreciation all at the same time, and you balance those accordingly so that when you have a day like yesterday, so where the market's off 2%, your portfolio is down half of that or less. And that's how we build our portfolios here. We focus on total return over time. We want to participate with markets, but we also want that defense side of the ledger. So we add things that create increase income or those type of things to provide some shelter. So yeah, the only thing you should ever focus on is total return, not just chasing markets.
Yeah, I think that's a great point. And, I think that we continue to hear these narratives. And, I heard this for years where, you focus on companies that only grow their dividends. And while that's great, but at some point they may run out of free cash flow. At some point we may have other issues. But what happens if they get company-specific news or you get sector-specific news that draws them down significantly? How are you going to react? I think that's one thing that a lot of people don't talk about is that emotional aspect of it. Okay, you've put all your funds into something that pays you a great yield. But what happens if it declines 20, 30, 40%? Are you going to sell? And then where do you go from there? And so the argument is always that I hear, and I'm sure you hear this often too, Lance, like, well, I don't care what it is. I can take the downside as long as I'm continuing to get the dividend income to live on. Well, that's true.
But psychologically, you don't survive that.
Yeah, most people don't do it.
And psychologically, it's like, oh yeah, I saw this a lot in 2008. I was like, I don't worry about market drawdowns because I'm just collecting all these dividend yields. Well, when you lose 50% of your capital, yeah, you're still getting the dividend yield, but then two things happen. When you have big market declines, companies cut their dividends, so now you're not getting your income, and now you've lost half your capital. So, that whole strategy of just I'm investing for the dividends has really bad outcomes when it occurs. It doesn't happen often, but when it happens, it usually happens at the worst possible time. It's not a great outcome.
Well, and if that were the case, and in fact, we had a discussion with the client a week or so ago about, looking at, okay, well, you could buy a Treasury yield and back into exactly what you would want to get. or, you could buy XYZ company. And they were actually alluding, I'd rather buy the company. I'm like, well, wait a second, because that company is only going to be backed by so much, what they have on the balance sheet.
Sure.
Versus a Treasury yield, which, we know what the government can do. I know there's lots of concerns out there about the yields. However, I would sleep better at night, even with the volatility like we saw here yesterday. I'd feel a heck of a lot better on that, knowing that yield's going to continue to come, because it is going to be backed by the full faith and pledge of the government. But either way, so always good to hear your thoughts on that. Another one here, what can I do to lower taxes in retirement? And this was a pretty big prevailing theme we saw over the weekend. I mean, I have a big, I actually brought some in case you guys were sleeping this morning. These are questions from this weekend. I mean, quite a few. And a lot of them were actually centered around some stuff we're talking about today, but a lot of that on how do you lower taxes in retirement. And I think that, number one, this needs to be something that you're discussing and thinking about well in advance of retirement. There's lots of things you can do as far as where do you accumulate assets, how are you putting them in which type of accounts, giving yourself the flexibility to, not have such a big burden when you get to retirement from a tax perspective. But, Uncle Sam always wants their paycheck. So we need to think about this in a couple different ways. Number one, your retirement account. It's not all yours. You have to think of it. It is actually a joint account between you and the government. So you're essentially going to have to figure out ways to distribute very thoughtfully over the years to reduce the burden that you have to pay Uncle Sam. We had Ed Slott this weekend. If you didn't hear about our summit or you weren't there, weren't able to attend, he's kind of America's IRA expert. And he made a lot of really good points around this. And I think that, the biggest point is that we have been in a lower tax brackets than what we've historically seen. And we need to take advantage of them while we can. And so if you're already in retirement, thoughtful distributions, what can you do before you reach required minimum distribution age? Thinking about staying under IRMA for Medicare, but then converting to give yourself a lot more flexibility in the future and go ahead and get that burden off the table. And I've seen this with clients where we've done Roth conversions or some that have chosen not to. And you see that compounding of returns over time. And you may do a conversion, but it's like, oh my gosh, we're right back to where we were, especially in a good market environment. And it makes it a challenge. So you have to start thinking to yourself, do I want to have those returns compound in a, say, Roth or an account that's going to have a little bit more tax control? Or do I want to have that happen inside my pre-tax accounts like a 401k, traditional IRA, where any dollar you pull out is going to be taxed at ordinary income tax rates? So those are all things to consider. I think it's really important. I'll go back to this, which I always do, is go build a plan. I think create the foundation. Then from there, if we all have accurate data, we can start to back into, should you be converting? How much should it be? And I think that's where over time, you're going to find a kind of that break-even point. Number one, how long do you have to live if you pay the taxes now to get those funds back? But then also, what is the intent of the assets? Obviously, to live on, to keep your income tax. We always want to keep more money in your pocket and out of Uncle Sam's, right? Legally, right? There's lots of, we use the tax code. But if you have legacy intent, we need to consider that. What does that look like? Where are the best assets to gift? But really, ultimately, this will always come down to, how do you keep more money in your pocket, the hard-earned money that you worked for? Now we need to think about how do we distribute it over time so that you're not writing such a big check. So let's see here. Sorry, I was talking there. I don't know what the next questions are, Lance. What have you been doing, man?
Well, no, I thought you had your whole list there. So
I do. We've gone through them.
Okay, cool. Well, there's Scott made a good point. He says we don't need bigger TVs. We need more value in our money. This is one of the misconceptions about the dollar that goes on a lot. Everybody's like, oh, we're losing purchasing power. Yes, as we've stated before here on the show, you are. If you just take that dollar and stick it in a jar somewhere and bury it under your mattress, you're going to lose value because of inflation over time. So that's just a function. The whole dollar depreciation that people talk about is simply just a function of inflation. And without inflation, you have no economic growth. But think about it differently. Scott, it's a good point. It's a good point you make. We need more value for a dollar. I don't know how old you are, Scott. I'm 60. And so I grew up in a time where our house was 1,100 square feet. It was one and a half bathrooms, 3 bedrooms. It had a decent yard to it. But there was nothing special about that house. The construction back in those days were, especially in the town I grew up in, was not fantastic. I mean, there was no frills, there was no, fancy anything. It had electricity and it had running water, and outside of that,
but you didn't need any of that either.
Right, you didn't need the electricity and water back then. We just used sticks.
No, the frills. I'm not talking about electricity and water.
Yeah. But you even think about the cars, right? The cars that we drove back there, very basic cars, right?
Yeah.
I mean, we had a Chevy Impala that was a 1965 Chevy Impala that was just extremely basic. Had an engine, had four wheels and, windows, and outside of that, that was it. But you think about today, versus then, right? We didn't have cell phones, we didn't have computers, we didn't have all these types of things that we have today. Think about your life today, and you talk about the value of your dollar. Yes, if you simply want to measure things in the uninvested value of the dollar, then yes, the dollar has less value today than it did 40, 50, 60 years ago because of inflation, because we've had economic growth and economic prosperity. But if you think about the lifestyle that you live today, think about your house, think about all the car that you drive, all the stuff that's in your car these days, your cell phone, your computers, the clothes you wear are better, much better quality today than they were back then. So again, you think about the value in terms of the lifestyle that you live. The value of that dollar has a lot more value to it today because of what it can buy you in terms of convenience, in terms of time, in terms of service, all those type of things. So what's important, and the mistake that people make is simply, you see these charts. It's like, here's the value of the dollar. It's lost 90% of its purchasing power since 1900. Yes, because of inflation. But that's why we invest. We invest to make sure that our purchasing power parity remains the same over time. So whether we buy gold or silver or stocks or bonds or whatever it is, all those have outperformed inflation over time. And it doesn't matter how you invest, as long as you invest those dollars will increase above the rate of inflation over time and ensure that your purchasing power parity remains the same. But the value of the dollar, you have to think about it in terms of the life that it buys you, the quality of the life that it buys you, which is immeasurably better. How about that? Is immeasurably better than it was back in the 60s. I remember my dad would sit around, we had to pay bills every month like everybody else. Right, you had to write checks back then. Nobody does that anymore. But, once a month, the electric man would come around and read the meter. So before the electric man came out, my dad would go take the meter off the house, roll the meter back, put it back on the house. And so I was the guy that had to hold the flashlight while he did this.
Does the statute of limitations run out on that?
Yeah, he's passed away now. Go get him. It was a family secret for like 80 years. But those were the ththings, right? I mean, it's just, you have to think about things, a little bit differently in terms, and look, these are great narratives, right? Scott, the narratives of all this are fantastic. Unfortunately, there's just no truth to them, but it's a great narrative that helps support market actions and those type of things. And so, Jen, it's just important to separate out narrative from reality and just kind of focus on what matters. Anyway, go ahead, Danny.
All right, so Scott, you did say no Roth for me. My income will be less, not more, and they will change the Roth tax. I guarantee it. Man, those are really big words. Now, I think it's really tough to guarantee something like that, but I want to just take a step back and put things in perspective. Number one, the Roth came from the Tax Relief Act in 1997. We really didn't see Roths in earnest till about 2006, so about 20 years ago. But the amount of money that is in pre-tax far exceeds the amount of money that's in a Roth. So keep in mind, pre-tax, just what we think of it, right? Money goes in, you don't pay the taxes, and it's going to grow tax deferred. You pull the money out, it's going to be taxed. There's about $48 to $50 trillion in pre-tax accounts. So think IRAs, 401ks, 457s, 403bs. So an enormous amount. There's about 1.4 trillion in Roths. So Roth, the opposite. We've already put money in. We already pay taxes on the money that we're putting in. We get tax-free growth. We pull it out. We're not paying any taxes. And there's been a common theme over the years, and especially here recently. With the amount of government debt, do you think they want your money now or do they want it later? They want it now. So they're making a lot of loopholes to make it easier for us to access these funds. We see more and more where, even President Trump right now is trying to, right now we have a one-time home buyer distribution you can take before 59.5 without the 10% penalty, but you still pay the taxes.
Right.
They're trying to make that even larger to give you more flexibility, which we would call leakage. They are advocating for more contributions to Roths. So employer catch-ups. So employer matches, they're making employer catch-up provisions. Those matches they must make on catch-up is going to have to go into a Roth. So basically what you're saying is that the government's going to tax your funds now, and then they're going to come back and say, oh, well, we're going to tax them later. Now, there's been conversations in the past, with, Peter Thiel really brought Roth into the spotlight several years ago. He put about $2,000, put it in a Roth, invested in PayPal, used the system fantastic, and, he has the largest Roth man has ever heard of. That's the exception to the rule as well. That's not something that is normal. Most people don't have that type of balance in a Roth account. So when we think about this, now, I don't think they're going to come back and say, hey, you can't have that Roth IRA anymore. There's not enough money in it. They're trying to advocate for you to make and take money out of your traditional IRA to pay the taxes now. But if they did, it would likely be say, hey, we're no longer going to allow you to do this. Not coming back and saying, we're going to tax you on this as well. So I think we need to put that in perspective on, number one, the amount of money that is on the radar from a pre-tax perspective, but also what does that look like in the future, and how do they actually go out and say, oh, hey, Lance, we're going to double tax you now. Mm-hmm. I don't think people are going to be real happy about that.
Yeah.
So the more common idea or theme would be that, hey, we're going to limit the amount that you can have in that Roth IRA. Anything above this will begin, they'll treat it like probably a taxable account, more like a joint account or an individual account. You're going to pay interest, taxes on your interest, dividends, capital gains. That could be something they do. It's probably not on the horizon anytime soon. And Scott, you may not see it in your lifetime. Now, I'm not going to say with certainty or guarantee anything because good Lord knows what they're going to do, but I would be cautious with that. And I would think maybe a little bit, broader in as far as what they can and can't do, and probably how quickly something like that were to happen.
Yeah. So good question in chat. Have I turned bullish in 26? I was never bearish. So I don't know why you think I need to turn bullish. I've never, and as you know, I'm not either bullish nor bearish. We're just looking at markets for the way they trade. So we just, look at extremes, look at deviations, look at, rotations, those type of things. But no, I'm optimistic for 2026. I think markets will potentially be higher again this year. We've had 3 years of 20% returns. It's been great for portfolios. I think you're going to see more volatility this year. Absolutely. I've got a whole series of articles talking about this reflation trade narrative and the risk to that narrative. And as is always the case, narratives are fine. I just think we need to understand both the bullish and the bearish case to each of these narratives, because again, the thing that gets us is risk. And when we just look at only one side of the case, it exposes us to risk one way or the other, right? I can be uber bearish and then the market goes up 20%. That's not great for our clients. If the market's up 20% and I'm only bullish and the market declines by 20%, that's not great for our clients. So again, our job is to navigate markets, not to be bullish or bearish. That's why our logo is an eagle. We just kind of look at the markets from above and say, these are the risks that we need to navigate and manage those accordingly. So anyway, also, Scott, the government is not broke. This is a very interesting concept. Government's broke, all this. So debt to GDP right now is about 113, 115%, something like that. Think about it this way. If you want to talk about being broke, the thing that people forget is that the U.S. government has $300 trillion worth of assets. Land, oil supplies, minerals, all these type of things, right? So, you have to have, when you talk about being broke, you have to think about it in terms of a balance sheet. Is the liability side of that balance sheet larger than the asset side? And that's not even necessarily entirely true either. That wouldn't make you broke. Think about this as an example. Scott, let's say that you have $100,000 worth of income And so you make $100,000 and you're doing great. So you go buy a $300,000 house. And so just for round numbers, you're able to get a no money down mortgage like we were back in the day. So you've now got $300,000 in debt and you've got $100,000 worth of income. You're not broke, right? You can service the debt because you have income and the debt is not due and payable all at once today. So the government's not broke, right? And at 115 to 120% of debt to GDP, I mean, however you want to calculate it, the economy is growing very robustly. And if the economy keeps growing at the way that they're growing, the deficit's already declining. And, you know, we went on this whole spending spree back in 2020, so we're having to work through that process. But again, things are starting to return back to normal. So if the economy continues to grow, and that's kind of the key factor here, is that we continue to grow, continue to create more revenue and income, but that's how we service the debt. So, you know, don't fall into that trap that the government's broke because it's not. So anyway, go ahead.
Well, and that goes back to GDP. I mean, if you think about this compared to, you know, actually back in growth into the equation, we're still much, much better off than most other countries. So still lots of questions on the Roth coming through. So number one, means testing. You're already being means tested right now. So if you think about this, Social Security is means tested at the moment. If you make more than $32,000, between 32 and 44, up to 50% of your Social Security is taxable. If you make more than 44, up to 85% of that is taxable. So most of you out there right now are already paying or being means tested. Social Security, Medicare, IRMA, Medicare premium surcharge. That is means tested based on the income you have. So we're already seeing that. We call those back pocket taxes. That's something that is already occurring. Another question, high state income tax. Is paying tax from withdrawal reduces the benefit? Is it still worth it? Well, it depends. Everybody's situation is different. Depends on the scenario. Depends on what state you're in. And are you going to stay there? Are you going to retire? I had a conversation with somebody yesterday. Said, hey, we're looking to retire or move to a state with no income tax and lower property taxes. Well, fantastic. Well, then if that is the case and we're certain of that, well, then let's be strategic. We probably want to have you do those conversions in a place where it's going to go, your bang for your buck's much better. So that is something that we'll look at down the road. So just know your situation is different from everybody. There's no one size fits all. Question, 60-40 pre-tax, post-tax, a good ratio. Depends the level of assets, what your distributions need to be, and what is your required minimum distribution going to be in, you know, at your RMDH. I think that's a big caveat, right? So going back to the means testing aspect of it, we may want to get a lot of those funds out of that. So, you know, your pre-tax, post-tax scenario looks a little bit different. Goes back to that legacy intent, you know, all of those things we've discussed. What do you got here, Lance? Mm-hmm. Would you recommend how to invest for a 6-year-old child in an UGMA account?
SPY.
Yeah.
Just buy an index.
Pretty basic. You know, I have UGMA accounts for my kids, and I let them invest. Now, mine are a little bit older than 6. They are 12, 11, and 9. Now, they also live with me, so they hear this stuff all day long. But I think SPY is obviously, like Lance said, probably the easiest way. But I'd also allow them to go out and invest and make some mistakes. I'd rather them make a small mistake now and learn versus a huge one later. But you can also learn a lot about their personalities. Like one I have will be much more aggressive than the other two. And he lets them know. When the market's up, he's real quiet when the market's down, which is, you know, everybody.
Yesterday he wasn't saying a word.
Oh, nothing. I mean, it's funny. He'll go grab my phone. They don't have phones. And he'll be like, hey, I want to check my stock. And he gets all serious about it. Oh, man, I'm down today. But he won't tell his brother and sister. Mm-hmm. But, man, when he's up, hey, man, I'm up like $200. What are you guys doing today? And I'm like, shut up. I don't want to hear it. But no, SPY is the easiest way. I do think as maybe they get a little bit older, having some conversations, let them make a list of companies they like or things they buy, and then start to break it down. If you can teach them a little bit about how would you analyze a company, what do they think about the future? I mean, I think just the basics are great, but don't treat it like a casino. And, you know, I think a big problem we can do is allow them to trade too frequently. But, you know, UGMAs I think are fantastic. My kids have them for, you know, any money they earn on the street or allowance money, they want to put it in there. We always talk about, you know, spend, share, give. So, either tithing, giving to a charity, helping somebody, saving a specific amount, and then spending a portion. And that's always an interesting dynamic to see who does what. I've been pretty lucky. They've all been pretty good savers.
Yep. So the one of the other things is how to invest. So when you're talking about investing for a 6-year-old, again, it depends also on how much money that you have to invest to start with. Start with basically an S&P index fund right now, because they have a long time, right? So they've got decades ahead of them. So buy an S&P index fund to start, but as it grows, you can start to kind of diversify that out a little bit as you can get some money allocated. Add some international, add some emerging markets. Add a little bit of real estate, those type of things. We have an accumulator model on SimpleVisor that's we just launched last August. It's doing exceptionally well because it's a good, well-diversified portfolio. Minimum investment for that is like $2,000. So it doesn't take a lot to get it started and to have a diversified allocation, but that will grow for you over time. And you just kind of add to that model as you go for the kids. And then once they turn 18, of course, it becomes theirs. So what's crucially important is that you have some education. It's great that you're doing that. I'm not all for it, but you have to educate them along the way, kind of like Danny's doing with his kids, because what happens at 18 is you have to transfer ownership of that account to them. And when they get that money, it's their money. They can do whatever they want with it. And unfortunately, it tends to wind up going to cars or whatever it is at the time. So make sure that you're also providing them the education. Don't just do this as a benefit, but also educate them along the way and say, look, you need to leave this alone and let it grow. It's now yours at 18, but you need to leave this alone and let it grow. And then once you get your job, you need to start contributing to this account so that you can grow wealth, into your retirement age. And again, this is one thing that we don't do well, and this is why there's so many people upset about, we hear these terms about financial nihilism, which isn't a real thing, but we don't teach financial education. We don't teach kids how to grow money and build wealth, and we don't teach them patience to say, let this work for you over the long term. It's, again, like Danny was talking about earlier with the 401k plans. The whole purpose of the 401k plan was to be your pension. Since we got rid of pensions, that's your pension. You should not be touching it for any reason whatsoever. There is no valid reason to touch your 401k plan ever. But we give people all this access to them to take out for, medical expenses or this expense or that expense. And then they wind up with retirement with no money because they've taken all the money out of the 401k for all these other reasons that we give them access to. So again, you just got to focus on the long term. It's hard.
Yeah. So a couple good questions just came in regarding this. So why not risk management for young people? We never said that. I think risk management should and can be for everybody. Yeah. I think young people have a much larger time horizon, which really smooths that out, and they can use it to their advantage. Whereas somebody who's near or in retirement, it's a lot different story, much different.
And again, there's a vast difference between us who do risk management every single day versus you at home that are working a full-time job, trying to raise a family. You need easy. You need the easy button for this so that you just invest it, add to it, dollar cost average, let time work for you. It'll work. You just have to give it time to work.
If you are young, you want volatility. If you're older and you're in retirement, you don't want nearly as much volatility because when you're young, you're accumulating. Think about the years, even in the large dips, if you were still working in, the early 2000s or 2008, if you were younger or starting in your working career, that was a tremendous advantage. You were buying the market so much cheaper. You had the wind at your back for a decade. So I think we need to put that in perspective. I do think that there's risk management should always be a part of it. Somebody else said, what about, you should start with a CD. I think absolutely. You need to start with, the foundation, as we would talk about with anybody, is that, okay, what are emergency funds? What are you going to need here in the not so distant future? And we talk about the financial vulnerability cushion, maybe adding a little bit. A child's not going to have to worry about that because they're not going to lose their job. But I do think that teaching them how to build that out and then saying, okay, here's how we're going to invest. Here's how you should allocate funds is extremely important. And it's never too early to teach. Now, a 2-year-old, as somebody alluded to here, buying pull-ups, well, they're not going to be able to articulate that.
Exactly. get ready to wrap up here. One question. I have my entire savings in gold and silver. I don't save in fiat. Actually, yes, you are saving entirely in fiat currency because you have to use dollars. Gold and silver only trade in dollars around the world. That's everything trades through the mercantile exchanges or the COMEX, one of the two. So all prices of gold and silver are traded in futures. And that's why they're only bought and sold in dollars. That's why gold is the reserve currency support for central banks. That's why central banks buy gold, is to store dollar reserves in, for their reserve balances. And that's how they control their currency fluctuations. But when you buy gold and silver, yes, you are absolutely 100% invested in fiat currency, because in order to capitalize on gold and silver, if you ever need it for any reason whatsoever, other than being a chunk of metal sitting in a basement somewhere, you have to convert it back into what? Dollars. So you are in dollars. You just have a different form of the dollar. And as we talked about before, that's a good thing, because you need to have those fiat dollars invested so that they grow at a rate faster than inflation over time, which is what they've been doing. And that's fantastic. So the investment in gold and silver is fine as long as you're good with the volatility. But you are invested in fiat currencies because you have to convert it back to dollars to spend it ultimately. So
I love how everybody's a silver and gold guru now. I mean, I love all of you guys out here, but y'all were real quiet about 2 years ago.
Yes. And Scott, yes, you can trade gold privately. That's completely fine. But if you want to spend it, you convert it back to dollars.
And there's nothing wrong with any of that. I mean, we own it as well. I mean, I think it's really great since the last year or two.
Yeah. And again, it's been great. It's been fantastic, and it's going through a superior bull market right now. That's fantastic. That will end ultimately, as all bull markets do. They will end, and then you go through a very long period of a secular bear market in commodities, which happens repeatedly throughout history. So again, this is why, I was talking about it at the conference. I had a client of mine. He called me the other day, completely out of breath, loading up silver to take it down to the dealer to sell it, because he's like, I will never see these prices again in my lifetime. And that's smart. He understands that that's what's going on now, and supply and demand will rebalance at some point, because high prices cure high prices. That's just a function of how markets work. So something will happen and these prices will go away. But yes, it is a fiat currency. You have to convert it back into dollars. And that's the whole reason we invest, right? So the whole reason we invest is that at some point, we're going to need those dollars for retirement, health expenses, whatever they are. And in order to pay for those things, I can't take a gold brick down to my doctor and say, well, he would probably take it, but you're going to wind up way overpaying for whatever services you are, because you can't just shave off a little smidge here and there. But you're going to have to convert that back to dollars. And so again, that's why you are always and forever in fiat currencies. Same thing with Bitcoin.
So does that fizzle out, or do you think it goes out with a bang?
What?
Well, I mean,
commodity prices?
Yeah,
they go out with a bang always. They don't just fizzle over time. They rocket ship higher and they rocket ship lower.
Yeah.
But that's just how commodities work, because it's a supply-demand imbalance. And so right now you have a supply-demand imbalance, but that will reverse itself eventually. Because again, high prices will eventually drag a lot of supply back into the markets, because people will go, I need to capture this high price, and that will happen. So just a function of time. Got anything else?
Nope. I think that's about it. I think lots of really good questions today. Keep them coming. We'll address more next week.
Perfect.
This is great.
Yeah. So, by the way, you were very fortunate today. You didn't have to hear about the summit interview process. So, no ad for the summit. So glad to have that behind us. Maybe we'll do it again next year. We'll see. So, but be sure to like and subscribe to the channel. We appreciate it very much. And get by the website, realinvestmentadvice.com. Somebody at the conference said you're bringing Rhett back. I'm not sure about that. So why? You're coming back tomorrow. Okay. For one day only, Rhett's coming back. Okay. That'll make Chad happy. Anyway, all right. That wraps up the show for the day. All right. Y'all see y'all back here tomorrow with Michael Leibowitz. See you then.